Inflation hasn't been a relevant risk for a long time. It's becoming a more relevant risk now, and we think headline CPI is going to move up quite aggressively, particularly in the US, over the next several months. After that, in the second half of the year, that headline US inflation number will drift back down again, but it will remain at a level higher than it's been on average for a long time. When we're talking about more inflation, often it conjures up reminiscences of historical periods of the 70s, the 80s, when we saw double-digit inflation. That's not going to happen. We're definitely talking about a little bit more inflation than we've seen in the last couple of decades. There's a number of factors driving this theme. We're seeing things like crude oil contribute more to inflation. That's the first driver, and it's probably the least important. More relevant, a broader set of input prices are rising. If we look at survey data in the US, for example, the Purchasing Managers Index, the input price subcomponent there is as high as it's been in 25, 30 years. It tells you there's a broad-based cost increase going on, partly because of bottlenecks and supply constraints in the global economy. But it looks like it's a bit more broad than that. Partly it's being driven by the weakness we've seen in the US dollar over the last 9 to 12 months. Growth is going to be extraordinarily strong over the next several quarters, and that will encourage further inflation. I think it's a mix of cost push and demand pull pressures that are now, particularly in the US, making inflation a more relevant risk for portfolios. The other key element in this story is policymakers. Their incentive to generate a little bit more inflation has increased compared to recent decades. And that incentive has increased particularly because of the high level of debt. And then the Fed has got more ability to generate a bit more inflation than in past decades. Instead of targeting an inflation rate in the long term of 2.0%, they're now targeting an average inflation rate of 2.0%. They're willing to run policy a little bit hotter to generate a little bit more inflation, which helps pay off debt. So I think there's a big confluence of events and factors aligning here that suggest a little bit more inflation in the long term is likely to happen. You think about the traditional equity-centric balanced portfolio, it's driven by economic growth. It's unsighted in the face of inflation. A balanced portfolio does really well when equities do well, and equities do really well when growth is relatively strong and inflation is benign. If we step out of that state of the world, the outlook for a balanced portfolio is less attractive. And so with a little bit more inflation, it means that the balanced portfolio performance is going to need a bit of help from somewhere else. For investors, in the face of more inflation, it's important to think about those asset classes that do well when inflation is higher. And here we think about real assets, things like commodities, particularly crude oil. Think about precious metals, including gold. Think about real estate, infrastructure. These are all assets that you can either think of them as an inflation hedge, so they protect a portfolio against the risk of more inflation, or think of them as an opportunity to benefit when inflation's a little bit higher. But either way, real assets are often the focus of solutions to protect or take advantage of inflation.